Hi, Steve Bedell here with you, and today I'm going to talk about part one of a little series that I'm doing on some methods of creative financing. So this is number one, and I picked subject to. It might not be one of the most common. It's one of the top three, but I know everyone looks at seller finance and lease to own. Those are probably the two biggies, but subject to is probably number three, and it's used all over the place. It's used every day. Now, the reason I'm doing that, the reason I'm starting with this, is because I'm going to tell you about a personal example that I have with this that I think will really drive home why these financing ideas are so beneficial and helpful to both buyer and seller. So that's the whole point of why we use these, because if it isn't beneficial to me, I'm not going to do it as a buyer, and if it isn't beneficial to the seller, he's not going to do it, and I don't want him to do it. So they have to be a classic win-win deal that benefits everyone. And that's why I want to tell you about this one, because I'm going to tell you it's actually a failed deal, and I'm going to show you why it would have been so much better than if he didn't go a traditional route with financing and realtors and all of that kind of stuff. Okay? Okay, so with that in mind, here we go. Subject to mortgage, they call it subject to mortgage, they call it subject to, they call it sub to. There's even a couple other names that people have, but you get the idea. Now, what is subject to? Subject to is when the buyer purchases a property subject to the existing mortgage. Done every day. You might read that it's subject to the existing loan, and when you go in there to buy it, if you do, then you have to pay off that loan. It's not true. There's a line on the closing form. I'll get a picture and probably stick it in here that says right on the HUD form, subject to existing loans. Now, you may go to a title company, which you don't do that anyway. They may tell you different, because when you do these kind of transactions, do not use a title company. I use title companies every day for traditional real estate transactions, and they're just fine. Title companies are very good at filling in the blanks and getting all the information and putting everything in order for you on those forms, so that when you go to closing, everything looks good, everybody's paid the correct amount of money. That's what title companies are for. But if you use anything out of the ordinary, use a lawyer. I use a lawyer. I not only use a lawyer, I use a good real estate lawyer, and I use a good real estater who does creative financing and alternative finance. So he knows what he's doing. And not only that, here's the big thing. If you have any issues at all down the road with anything, if you have a title company, they're just going to say, you're on your own. We just fill in the blanks. A lawyer will stand by his work and protect you. Okay? So lots of reasons right there. No title companies for creative financing. Get a lawyer. All right. So here's some of the advantages. The buyer has ownership. When you do a subject to deal, you go buy it. When the deal is done, you own that property. So you're buying a property subject to the existing mortgage. We'll look at some examples of just how that works in a minute here. All right? Now we got the seller. The seller mortgage stays in the seller's name. He doesn't own the property. He is still responsible for that debt, because everything is in his name. So that's really critical. That's a really critical point to remember. Let's take a little bit of time here now to take a look at the pros and cons of doing a subject to deal from both the seller side and the buyer side. Before I do that, though, I do want to remind you that, hey, I'm just not promoting myself as any kind of expert or guru or anything like that. But if you want to know everything and get my course, it's usually $9,450. But today, for you, if you call within 20 minutes, it's only $10. And you're going to earn $100,000 next week. How about that? Okay. All right. Just kidding. We all know what we're talking about here, don't we? Alright, again, I'll show you what I'm talking about, and I hope it's entertaining, and I hope it's informative for you. So let's take a look at the pros and cons. Here we go. Subject 2, for the seller. The seller, in most cases, they either are in financial trouble, or they need to leave in a hurry and dispose of the property quickly, or they have very little equity. It's some kind of situation like that. So the seller basically wants to get out of that property and move on with his life. So it's up to the buyer to handle that for him, and he can do that by taking over his mortgage. And in many cases, if they're a person who's been doing well, but they're struggling to keep that mortgage payment going, and they know if they don't, then their credit is just going to boom, fall off a cliff. So you save their credit. So that's the seller. You save the credit, we lose the debt. Now the cons for the seller, you got to hope the buyer keeps up the payments every month. That's a big thing. That's a big thing. He still has the mortgage. The seller still has the mortgage. The buyer has the property. The seller has the mortgage because it's subject to, still in his name. Alrighty? Now, so let's take a look at what happens on the buyer side. It says pros. Usually, it's not a large down payment. It it can vary. Sometimes the seller is maybe behind a couple of payments, and just by getting those up to date or so, you may be able to take over things. There's all kinds of different situations, but typically there's a very small down payment because the seller is walking away from things. He's walking away from equity. So if there's a lot of equity, you're probably not going to do that. Okay? There's no closing because, again, no change in the mortgage. There's no bank. We love that. Everybody loves having no bank. And you maybe get a low mortgage. Maybe you're buying a property that has a 3% mortgage on it, which is better than as we take this, there are probably a little under 7% right now. High 6s right now. But is 3% better than that? Oh yeah, quite a bit better. Cons. Seller could go bankrupt. What if this guy here goes bankrupt? He's got that mortgage that's going to take you with it. I'm not saying it's going to take you with it. I'm saying that's going to have an impact. You're going to have to figure out what to do with that property. And in most cases, you may have to pay for that property. You might have to pay it off. Insurance is a little tricky. Again, I'm not going to go into details here. There's a lot of little methods you can use, like assigning different people on insurance policies, that kind of thing. You must carry the property. You got to have the financial strength to carry that property if you're not getting any income for it. You made an obligation to this guy that you're going to pay him so much every month. You got to do it. It's irrelative what's coming into you. You got an obligation to this person. Due on sale clause. Now the due on sale clause, I mentioned it briefly before. Honest to God, I think we should probably have a separate whole video or something on the due on sale clause. If you watch a lot of the gurus and the big names, they're going to tell you, well, the due on sale clause is there, but the banks never call it. And it's pretty true. It's extremely rare that the banks are going to demand that the loan be paid off if they say the property has switched hands. They can. So there's the ways of getting around that. When you do a subject to, there's a couple of ways. You can do things so that the bank is not aware that the property has sold. You can tell the bank, some people recommend this, you can tell the bank, hey, I'm taking over the property, I'm going to be paying you now. They might go, oh, okay, that's fine. And they might do that. Why would they do that? Because banks do not like to be in the real estate business. They're in the banking business. They don't want to deal with real estate. Their REO departments, which is real estate owns, that's properties that they take back. It costs them a lot of money to do that, to get it back, and then to get it marketed and do all that stuff. They're not in the business of selling homes. They're in the business of making loans. They make their money on money. Alrighty? And how you set the property up, we're not going to do that either again, because I'm not a lawyer or an accountant, but a little rule of thumb here, you probably don't want it in your name. And a lot of times with these type of things, you don't want an LLC either. Just so, but you talk to your financial advisor, or your accountant, or your lawyer. The LLC, maybe not. Some kind of trust or a land trust, maybe. Okay, so look at those things. Alrighty? Okay, now we're going to move on, and I'm going to talk to you about a real example that is a deal that I was tried to do, but it didn't work. So I'm going to give you all the details on that, and I hope that's give you a very clear picture of just how these things work. Okay? Okay, let's go on. Okay, so I've changed things up here a little bit. I put a new put some new stuff up on the board. How's that? Okay. Now here's how. This is just a little simple, very simple drawing and explanation and example of how a subject to would work. Let's say somebody had a property for sale and you wanted to buy a subject to. Here's an example. House is $300,000. The mortgage is $250,000. For whatever reason, guy wants out, person wants out, can't pay the mortgage, doesn't want to pay the mortgage. Anyway, if we find that out, usually find out their why. So you get equity of $50,000 here. If the seller is open to it, you can say, hey, I'll pay you $50,000. You don't have to go to a bank. You don't have to go through all of that stuff. I'll pay you $50,000 and I will take over, or I will buy the house subject to the existing mortgage. If they say yes, you do all that, you write it up, you dot all the I's, you get your lawyer, you make sure everything is set, and you buy the property. Simple. Okay? And why would they do that? Well, there's a lot of reasons. But here's the big thing. Here's what I want to tell you about. Here's the deal. Now this is for real, in the Villages, Florida. My example. I saw an ad in the paper. Houses for sale. And it was an ad that person put, must be veteran, assume my VA loan. So I called up. I talked to the guy. His name is Joseph. Nice guy. Probably 85 years old. And here's the story behind Joseph. And this is what I really want to tell you, because this is why creative financing or looking at alternative ideas is so important and can really help people. So, here's Joseph's situation. He bought a house in the Villages. He lived in the Carolinas, and he bought a house sight unseen for $300,000. He had a VA loan, 100% financed, closing, everything. At his age, I'm not quite sure why he was interested in that, but it doesn't matter. He did. Him and his wife moved down. They got the VA loan. They're in the home, and they got a $300,000 mortgage. Well, of course, at that age, you got to expect they're going to have some health issues. So they started having health issues. The family lived a long ways away. It's pretty common in the Villages. And so they said, maybe we should be closer to home. But here they are sitting on this home, and they have its mortgaged to the hilt. They've only been there a year maybe at most, so they're just paying a bunch of interest and things. So they have almost zero equity in the place, or that's what you would think. But this was about 5 years ago, so that would make it, what, 2018, 19, somewhere in there. But here's what we come to find out. They paid too much for that house. They bought it sight unseen. It was overpriced. What can I tell you? It was sold, and they paid too much for it. So here's how that house looked. House. Value, $265,000. Can you see we got an issue here? We got a problem? Mortgage, $300,000. I'm just rounding off. I think it was like $299 or something. But anyway, it was a lot. Equity, $35,000 minus. So, he's got a problem there. So I went to see Joseph, and I I just bought a house. I wasn't in a position to go out and get a bank loan for it. And so I told them about subject 2. Anyway, we'll go through this again. No, they didn't want to do that. Like a lot of people, I think it's shifty, all this stuff, but whatever. So first off, I straightened out for them that you don't need to be a veteran to assume a VA loan. Maybe a lot of people think that way, but a VA loan, you need to be a veteran to get one. But once it's out there, it's an assumable mortgage. Anyone who qualifies can assume it. So I said, well, look, Joseph, let me do this. I took an option on the property. I wasn't a realtor at the time. And I was previous up in North for a while. And anyway, I wasn't licensed yet in Florida. I took an option on the property for $10, which is what I usually pay for options. As long as you have an option, you got an ironclad, you got the proper paperwork. I usually do it through DocuSign type of things where you've got a very strong record of it. So I took an option for $10, and I said, okay, I'll get someone to assume the loan. So, okay, so here's what happened. So we get a guy, and he says, yep, love the house, want to move over, qualifying, no problem, we'll take care of it. So what happens? He goes to qualify for the loan, doesn't qualify. Doesn't matter why, but he doesn't. Boom, he's out. So I went to Joseph again. I said, Joseph, you got to remember, he's still going to be on the hook, but he's mid-80s, not in good health. Is he going to go out and buy another house? No, he's moving home, be close to his family, might even move in with the family. So that's really not an issue. He shouldn't be buying a house. He shouldn't have bought that one. But if I took over, I was willing to take over this $300,000 mortgage on a $265,000 house, and I was ready to do it. But I had to fight. I had to fight him. Joseph was okay, but the wife, I just couldn't do it. So what did they do? Remember, I wasn't a realtor at the time. I referred a realtor that I know. I said, okay, I'm going to give it to a realtor. Well, what happens? Well, you know what happened. They sold the house. You're not going to sell a $265,000 house for $300. So they get the realtor. They sold the house for about $265. Then they had realtor fees. They had to go to the closing table minus tens of thousands of dollars. Now, what do you think would have been a better solution to that? Do you think maybe it would have? It really bothers me to this day that maybe my selling skills weren't great enough to convince them or something like that. But it bothers me to this day that I couldn't have helped them out with that deal, because I would have saved them $30,000, $40,000. But just because they thought it maybe looked a little shifty or something they weren't used to, they didn't do it. So I wanted to tell you this one first, because this is what creative financing or alternative finance is all about. Banks are there to make money. Banks are a pain in the butt. We all know that. You got to fit into all the blanks. I mean, you know, all the blank forms got to be filled out and everything got to be dotted and T. When really, if two people sit down together and say, okay, here's where I am, this is what I want. And then on your side you say, okay, this is what I need to get to help you out. And if I can help you out, and if we can make an agreement, well fine, then we'll do it. It's really that simple. I mean, you got to know the details and you got to do things right, of course, but that's how it is. You can benefit people greatly by doing this, by finding out what they really need. And if you can supply that, if you can help them with what they need, then boom, then you have a deal. Okay? Alright, so I hope you enjoyed that. I might get a little carried away because this deal still bugs me. Not because I didn't get the house, understand that. You know, if I got the house, I got the house. But because it just really makes me sad. Joseph was a great guy, and really hated to see him go down this road. But in any case, okay, that's it for this one. We'll wrap it up, and I'll see you next time. Maybe we'll have a happier story for you that time. All right, see you later now.